Welcome to an episode of the Global Investors Podcast. I'm your host, Charles Carillo. Today we have Morgan Ehrenzeller. He is mastered the art of creative finance, leveraging strategies such as seller finance, subject to, and lease options to acquire properties with minimal upfront capital. He has built a portfolio of 339 units across the U.S., starting with the purchase of his first duplex, which is financed with a down payment of only $5,000 in seller financing. And this initial investment set the stage for a career in real estate investing and deal structuring. Morgan, thank you so much for being on the show today.
Charles, thank you for having me. I appreciate it.
So you have a very interesting kind of background prior to getting into real estate at a very young age. Can you give us a little bit about your background before choosing to get into real estate?
Yeah, great question. So ever since I was little, growing up, since I can remember, since probably walking, my dad was a third generation carpenter. Obviously, back then I didn't know what I was going to be doing today, but fast forward, very, very, very thankful for that. So growing up, I had the pleasure of holding the flashlight, so to say, my entire upcoming. So I'm very, very familiar with construction, and it's, what I do today is very, very thankful for that. I know, everything from, ripping out footers, pouring new footers, all the way to the framing, your king studs, jack studs, your headers, the whole way up to roofing. I know it all. So very, very thankful for that. So that was a lot of, probably from age 4 to 16. So a lot of my dad would, make us work with him and at job sites, but also to learn for our future, because he saw that was valuable. So no one could rip us off or take advantage of us. So very thankful for that. And then at one point when I was 14, I created a software company, come from really, really humble beginnings. So I want to provide more for my future family at the time and get out of the scenarios that we were in. So I created a software company, did it with my partner, and then we sold that. I think I was 17 right before I went to college. Then I bought my first duplex at 17, then this has made a bitload of money with the software company. And then I had so much money, I didn't know what to do with it. But I knew every rich or wealthy person was involved in real estate. So that's kind of what got me into real estate. I bought a duplex when I was 17, $5,000 down, seller finance. And then I went to college at 17. And then I graduated college in 2020. Fast forward today, 27, and this is what we built in the past 4 or 5 years.
Wow. Yeah, it's awesome. Can you kind of provide a little bit of an overview of your current real estate investment strategy and kind of your deal criteria?
Yeah, great question. So mine is going to be much probably different than people who are older than me. Generally, when you're younger, you take bigger risks than when you get older. To make money in real estate, you have to play offense, but to keep money, this is in any investment, you also have to play defense to keep money. So for me, I'm 27. I realize my greatest asset is time. I have time on my hands, what a lot of people don't have. So for me, I only buy creative finance deals, 10% entry or less. One, because I have the deal flow to support it. So not a lot of people get that type of deal flow. The way I structured it and set it up was really, really intentional. But two, one of my apartment complex, because it's commercial stuff, I got a 46 unit for $20,000 down. Just last week, I closed on another 46 unit, $100,000 down. So I am very, very particular. I'm putting minimal to no money down. And I'll pay a little bit of a higher purchase price as long as I can make sure that, it cash flows on a DSCR basis. And I'll play the waiting game. Now, I do like value add stuff. That's better if I can get, value add stuff. But if I can get into something in an apartment complex for less than $100,000, I can raise that money very easily. I can make one phone call and raise that and then be 50-50 partners, where I'm not setting up a GP-LP or a fund scenario where I have to give 70-80% away to the deal. I also have the SEC breathing down my back, have to make sure every I's dotted, every T's crossed. Nothing wrong with that. But, if I had the choice of, a $500 setup or a $10,000 setup and the SEC down my back, I'm choosing the $500 setup. So that's a little bit about my strategy and what I do. Minimal down payment. It has to cash flow. I like secondary and tertiary markets because I'm after high cash on cash return. So that's really what I'm looking for. A lot of the stuff, the way we structure our capital stacks, if I get below a 30% cash on cash return, there's something wrong. Like 30 is the baseline minimum. Just the way when you structure capital stacks the correct way. So that's what I'm after. Cheap price per door, high cash on cash return. And then when I get my cash flow to a certain figure that I want that at, then I'm going to be moving that into more, new builds, Class A assets along the water in the Tampa region, or really high growth corridor areas like the Dallas-Fort Worth area, or something like that. So that's really my strategy. I like multifamily. I like the right retail, very, very specific. It has to be an incredible location. I'm not buying retail in a secondary or tertiary market. So it has to be in a grade A location to go into something like that asset class. And I'm also into warehousing and mobile home parks and RV parks. I like mobile home in the RV space. If your audience is listening to this, they're probably in real estate, and it's no secret that the housing affordability gap is getting bigger and bigger. I think everyone knows that. So I like the RV and mobile home park space for that. And we're roughly sitting at 6-7 million housing shortage. So we have that. The housing affordability gap's getting bigger and bigger. And arguably, I don't mean to get politics into this, but the last administration, brought 11 million illegal aliens into our country. Could argue probably more like 35, 40 million, but that big mix of that blend is why I'm really open to RV and mobile home parks as well. Because I think in 5 to 10 years, families aren't going to be able to afford to live in apartments or houses. So where's that going to force them to go? They're going to have to move in with friends and family. They're going to have to room share. They're going to have to house share, or they're going to go to RV parks or mobile home parks. So that's really what I'm focused on right now.
Yeah. The other thing too with mobile home parks is what I find is kind of a silver lining is that people don't really want them anymore. So there's not a influx of development. And if they are coming online, they're very high end and they're completely different demographic.
Yeah, that's a really good point too, because like around me, I know a lot of like the cities and stuff, they don't want any more RV or mobile home parks coming in. So I like that fact that the supply is almost in a sense limited. A lot of, around me in St. Petersburg, they don't want them coming in because then it attracts, I don't want to say bad people, but it comes with higher crime, more poverty, that type of thing. So it's almost if you have one now, there are a lot of cities and stuff, they're not allowing more to come. For those reasons. So I also like that factor too.
Yeah. It's one thing many years back, I remember a partner of my dad tried to sell him an auto salvage junkyard, right? And my dad's like, oh, I don't want to buy this or anything like this. And, he was like, well, they're not building any more of these. They're not going to allow this. These things are like environmental, like hazards and all, they're not going to get any more. They're never going to be like built again. So you have something that is grandfathered in. And, it kind of creates that moat around what you're doing where there's going to be a need for it. And if any type of new inventory comes on the market for mobile home parks, it's completely different. You're selling to someone that's, got a $250,000 camper or something like that. You know what I mean? Like it's a completely different, like a second home type thing. You know what I mean? So it's you're dealing with a whole different demographic that will never ever bleed into it. Like with when multifamily comes on, we can talk about Class A, new Class A bleeds into B, which bleeds into C, and it kind of makes its way down through. You're not going to have that. You're not going to have anybody that's like you're talking about that needs housing is never going to be like, you know what, maybe I'll go over here and spend, $2,000-$3,000 for like, this lake view trailer site.
You don't have the absorption too, like in multifamily, like you're saying, the new build comes on, they got to give concessions to fill it. And then a lot of the tenants are hopping, just get 2-3 months free rent and continually hopping and stuff like that.
Morgan, one thing you mentioned is interesting about your deal flow. And I recently was speaking to a friend of mine who's a hard money lender, and he was telling me that new hard money lenders, they make the mistake because they do a lot of bad deals because they don't have enough deal flow. You mentioned that you have a lot of deal flow. So can we talk about how you generate the majority of your deal flow? Obviously, it's time intensive because you mentioned that offhand competent earlier, but can you break that down a little bit about how you do that?
Yeah, that's a great question. So a lot of people are probably familiar with the basic generic stuff, driving for dollars, reaching out to realtors, that type of stuff. That's all outbound. I don't do outbound. I do inbound. So I set up everything, all my marketing stuff where deals get flooded to me, so I don't have to go out and do the chasing. So every day I come into my inbox and I have at least 50, 75, 100 deals that I get to, go through that people are sending me. One, from that standpoint, but two, once you get known and have a reputation, it gets much easier, because when you're known and you can close deals and people know you can close deals and you have the resources and the capabilities, that's what every broker, that's what every wholesaler, that's what every seller wants. They want someone who can actually get the job done. At first it was a lot of that, but now it's just a lot of referrals and then, networking and stuff like that. And they'll often, people will take a lower dollar amount with my offer because they're more confident in me being able to get the thing done. So I think that's really important, and, building an online presence for in those critical moments, because I could, countless times for people before they even hopped on a call with me, oh, I Googled you, I seen, who you are, what you're doing, which made me, comfortable in why we want to do this with you versus someone else. So I think having, and establishing an online presence helps drastically with this, especially in the creative space, because a lot of it is, seller finance, sub-2, all that type of stuff. So the seller has to feel comfortable with you. And if you're a no one or have no presence online versus you have a presence, or you have a community or something like that, obviously it elevates your status there a little bit. So I think that's really important as well, with what I do and how it's all coming together.
So there's no outbound marketing. It's all inbound. So it's usually relationships that, other wholesalers, different. I imagine some of it comes from on market, some from realtors and stuff like that. Is that correct?
Yeah, some of it's, on market too. So I see people all the time saying, oh, you can't do this on market. And not that. It's just as important, I think, one, deal flow, but also negotiation skills. Knowing how to negotiate and knowing what to say and how to say it to a seller, and knowing the objections before they even come, incredibly valuable. So a lot of people are always asking, Morgan, how do you do your deal flow? No, it's not just deal flow, it's negotiation skills as well. My partner and I, we just bought we're under contract. We're going through to close here in a couple of weeks on a $1.3 million commercial building. It's been on the market for 60, 90 days. And we talked the seller into, a creative finance scenario. So anyone who says you can only do it with off market, they don't really know what they're doing, or they lack a huge negotiation aspect of the deal. But I just wanted to point that out, because I think most people overlook that part of it, is the negotiation aspect.
Do you have money sitting in the stock market and you're worried about it? Or worse, you have money sitting at the bank, not keeping up with inflation? My name is Charles Carillo, founder and managing partner of Harborside Partners. And since 2006, I've been investing my money and my family's money into income-producing properties. These are real assets, real properties with real addresses that produce real cash flow. At Harborside Partners, we provide passive investors who love real estate with a turnkey investing solution. If you want to put your money to work in real estate but can't find deals, don't have the time to get funding, and the last thing that productive people want to do is manage real estate. We find the deals, we fund the deals, and we manage the tenants, the termites, and the properties. Partner with us at investwithharborside.com. That's investwithharborside.com. Go to investwithharborside.com. If you love real estate, you like the idea of passive income, and believe that income-producing properties will appreciate over time, go to investwithharborside.com. That's investwithharborside.com.
Let's talk about that with it's on market, because if it's on market, it's with a broker who's supposed to have the seller's best interests in mind. It's much easier, obviously, if it's been sitting on the market for 2 or 3 months. But not only do you have to convince the seller, you have to get to them first. So you have to convince a broker to bring that to them. So obviously your online presence, past deals, that type of history allows you to kind of make that easier. But how does that pitch go when you're speaking to a broker to have them trust you enough that they'll bring it to their client?
Yeah. So generally a broker, in my opinion, they want to deal with someone who can get the job done and they can get their commission check. So generally with me, I'll tell them, hey, Google me, like, you'll see me. I just hosted an event. I had like Pace Morby there, David Green. There were speakers at our event. And I also let them know that I run a community called the Closers Table that I teach this stuff. So generally when I tell them that, and like I have, my own real estate community that we teach this stuff twice a weekend, they feel a lot more comfortable with me. And then in the mix of that online presence as well too. And then also from a standpoint, we do that, but if generally in the commercial world, stuff sits a lot longer than the residential world. Generally, I see, 6 to 9 months, some wiggle room in there in the commercial space, something will sit on the market for. So, finding stuff that's been sitting for a while and then going to that broker and say, hey, listen, what if I came with a solution where the seller, they could get close to their purchase price or their purchase price. I'll make sure your commissions are paid out on the front end. And is there any debt on the property? If there's any debt, can we assume that debt? And will the seller carry a second position? We'll give her some money in her pocket that she can walk with. But then also more importantly than this is finding out the why and the what, why they're selling and what their reason for selling is. So example, that one in Indiana I just told you about, 1.3 million. Her why was she lives in Indiana, her nieces, her nephews, her cousins, family moved to Tennessee. That was her why and her what. So that was most important to her. So a lot of this is, negotiation is sales 101. You find the pain and you tie that back to how your offer is the solution to that pain. So that's how we did that one, is negotiating it through that angle and that lens, if that makes sense.
Yeah, no, that makes perfect sense. Obviously, it becomes trickier when there's debt on it. But for example, if you're buying a property and it's got, it's already got a loan on it, you can assume that you're covering some of the equity they've built in that property as a second mortgage. And then you're coming in with a minimal down payment, which is going to put a little bit of money in their pocket, but mainly cover the broker's commission, I guess is kind of how you really structure this when there's debt.
Yeah. And then too, I'll ask them, what's your plans with the money afterwards? Is it just sitting in a bank? 9 times out of 10, I don't have any plans with it. Okay, you earn 1-2% there. I'll pay you 5-6%. So then breaking that down to them, like, hey, look, if you accept a cash offer, this is what you're going to get, and here's what your money's going to be. Versus you accept my offer, I'm going to pay you out in a balloon in 3-5 years. Look at all this extra interest you're earning. I'm giving you a higher purchase price too. So when you break that down for them and show them, like, hey, you're making an extra $200,000-$400,000 by waiting 3 years. You're literally making over 6 figures a year doing nothing, absolutely nothing. So that's very compelling to a lot of them. But I've had other ones too, like example, a seller, she was at Medicare, Medicaid. She had an income limit. If she went over that income limit, her insurance would get messed up. So we had the structure in a way that if she sold it, she lost her insurance. So that was the black swan in that one, and covering that and structuring it in a way that she could keep her insurance, as well as selling the property for what she wanted for it. So that's another example of one, but it's really, like I said, finding the pain and tying, really hovering down on that pain and using really good negotiation skills.
I just want to drill down a bit into a little bit more into the details of how you normally structure a deal. And obviously we know about, as we just explained, with having a second mortgage and assuming if that's possible, obviously if they own it outright, that makes it even easier. But you said 3 to 5 years, then a balloon. Like, how do you structure this? Do you try to go out as long as possible, depending on your situation is different? I understand that, but 3 years, 5 years, 10 years, no prepayment penalty gives you enough time. I guess the goal down the road is to refinance them out. Is that correct?
Yep, that's exactly right. And the way I structure mine is for my capital partners, since these are so the capital stack is very, very favorable for the buyer. Most investors, this is a new world to them. They don't realize how good these returns are in my world versus the traditional world. Obviously, in the investor world, the more debt you leverage, the higher our RIRs, our equity multiples, all that good stuff. So the way mine are structured is, for me personally, what works for myself and my investors is I'll find the deal, I'll run head-on operations, I'll do A to Z everything. They provide the capital for the project, and then they get all the cash flow that project produces. So all the cash flow goes to them. And then I work for free for the first 12, 24, 36 months. And, most of these are value adds. So we're going in where, they're 50, 60, 70% expense ratio. We're putting operational efficiencies in there, running them, to be 30, 35 to 40% expense ratios. So a lot of these where, we're creating value adds in multiple aspects. One, rent increases. Two, that could be utility bill backs or operational efficiency and, restructuring contract vendors, stuff like that. So that's generally how and why mine are structured the way it is, because it works for my investors. It keeps their capital prioritized. And then I work for free for the first 12 to 36 months, which is why we do that balloon. Because at some point, I don't want to work for free for 5 years on this project. And then once that balloon comes and they pay out and has returned all their capital, then we're 50-50 on the refinance proceeds and all the future cash flow. So that's why they're structured in 3-5 year balloons. One, because I want to refinance to get my investor all their capital back, and then also for all the work that I've just worked for free for the first couple years for, if that makes sense.
Yeah, no, it makes perfect sense. The other thing too is that I'd rather be dealing with a seller that I bought a property with after 5 years that I've been paying monthly, and if we're getting ourselves into a recession, have to renegotiate with them and maybe extend it a little bit than going to having to negotiate with a regional bank. You know what I mean? Who's about to give you a little bit more leverage. And it's that as I've gotten further and further into my real estate investing career, I've realized that these type of relationships are overlooked by novice investors. However, they're extremely important when you're investing in property. The relationship that the main investor, the syndicator, the head, what do you want to call them, GP has with the lender. And that can make or break a deal down the road if you hit on hard times.
Yep. No, absolutely. And that's a really good point too. And a lot of these, like if we're taking over a first position, the seller's carrying a second position. Like I have one, the 46 unit I closed last week. She's carrying her $1.81 million note at 0% interest for 6 years. So like that one will refinance with Freddie or Franny. My contact, they can keep her on as a second position. So we'll refinance out of the first position into a lower rate, keep her in at 0% on the second position, and then we'll ride that out for the next 6 years at 0%.
Interesting. Yeah, I think one of the things too I found with seller financing deals, I think it's overlooked. Everybody is just getting in with minimal money down, which I understand is, we're going to really increase our cash on cash returns. However, the other thing too is when you step away from a traditional lender and you start using the seller as being a lender, there's a lot of fees that you're avoiding as the buyer. And that allows you not only to pay more, like you said, so you can get a lower down payment, but also, it's not unreal for 3 to 5% of your loan amount to be, tacked on as fees between originations, between this. And if you're working through a broker, that goes to 5%. You know what I mean? So it adds up, $100 million property, that's $50,000, a $2 million property, that's $100,000 that you are avoiding, or you can pay. You can sweeten the pot on the seller side because, hey, I don't have to pay this for originations. I can pay more for the deal.
Yeah, absolutely. And then, this is slippery slope. Like you have, environmental reports, inspections, the whole nine. And I know, the bank loves to spend other people's money. They love to spend other people's money.
Yeah. When you look at that closing statement and you get it, and you're reviewing it, you see all the people that you're keeping in business by buying this property. And,
what is it? 21 or 23 people are involved in a real estate transaction.
It's crazy. And to my overnighting with FedEx is getting paid on it, the whole 9 yards. So it's quite the business. But the thing though is that if you're able to, obviously some things you want to do anyway, you can, get your phase one and stuff like that at all times. But the thing though is that there's a lot of junk in there that you don't need. You know what I mean? The seller that owns the property for decades knows more about that property than anyone probably in the world. So if they're going to hold paper on it, they don't need to bring in an appraiser. They know exactly what happens. They know exactly, you know what I mean? It's just like if you owned a car for 10 years, you pretty much know everything about what's going to happen with that car, and what's ready to go and what's gone. You know what I mean?
Oh yeah. And even as inspections, like since I'm very, very familiar with construction, like I'll do all these myself. And, you hire a third party to do an inspection report on a 30 or 40 unit property, you're going to spend 20, 30, 40 grand on that alone.
Mm-hmm. So you talked about building trust with, using all your past deals, your community, your education, everything you've done over these years as a real estate investor. When you're getting on one-on-one with the actual seller, because at some point I imagine this happens, and especially if you sign something with a wholesaler saying you can do it, or the broker allows you to do it or whatever, how are you on those phone calls as you're building rapport? Is that, what is the process like? What is the time frame on something like this before the first time you speak to someone to maybe when you're actually buying their property?
I'd say about roughly like 30 minutes. As far as like the brokers and the wholesalers, yes, you do that, but I'm just a very straight and blunt person. Like when I'm talking to them, like I'll tell the broker, obviously they want to, they want to feel important that they're playing middleman. So, I'll tell the broker straight up, listen, if you want this deal to happen, so you get your commission, listen, we all want this deal to happen. The seller wants the deal to happen. You want it to happen to get paid, and I want it to happen. So I'm the most experienced here with creative finance. Let me talk to the seller directly. You can be on the phone call, but for the sake of all of our interest of getting this done successfully, the highest probability is letting me talk to the seller directly. And that's what we all want. We all want the deal to go through. So, let's quit pissing around, wasting time. I don't have time to waste. I'm sure you don't have time to waste. Let me talk to them directly. That's our highest chance of everyone getting this deal done. And a lot of people in today aren't very blunt or honest or upfront like that. So they generally respect it a lot because everyone's beating around the bush and this and that. But I'm just completely upfront, blunt, and honest. One, because that's just who I am. And two, I don't got time to waste to be going back and forth. Oh, they said this, they said that, or like, I don't have time for the gossip or the drama. Let's get to the point here. So just being completely upfront and blunt like that is, I find that they respect it a lot.
Yeah, no, that makes perfect sense. And I think it's going to be very difficult for a seller to get into a long-term relationship with someone they don't know or even spoken to. And you're just going through the broker and they're like, oh yeah, everything's fine. Everything's going to be fine. And then something, you know what I mean? You really need to have that one-on-one or with the broker there kind of contact with them to really let them know what you're about, what your goals are, because I think it's very difficult, especially if you're a seller. I would see that coming through a salesperson and you'd be like, I just can't, I need more before I sign on this.
Well, a lot of them too, like if I won't do this unless they really ask for it, but I'll give them references as well of other people I've done this with. And I'm like, you can call any of these references. I'm positive they will have nothing but great things to say. Like if you want, I'll show you my credit report. I never missed a single payment in my entire adult life. Like I can show you all of this stuff as well. But also if it's really, really pushing them, I'll say, listen, if this will help, I'll sign a performance deed. Do you know what a performance deed is by chance, Charles?
I've heard of it before, but if I've never used one myself.
So I'll give a quick refresher here for your audience. Performance deed is basically a piece of paper that says, listen, if I don't hold up to my end of the bargain, if I miss a single payment, this deed reverts back to you automatically. So now you don't have to go through a foreclosure process, the whole nine. Now, I'm not a licensed attorney or a CPA, so consult with one prior. So doing this and letting them know, like specifically that last deal is, we were just talking about that Indiana deal. She's a little on the edge. And for that deal, we were doing it with 80K down. Yeah. 80K down. She was on the edge. I was like, listen, seller, if I miss a single payment on this, the deed reverts back to you automatically. And then I lose my 80 grand. So I'm highly incentivized not to miss a single payment. Otherwise, I lose my $80,000 I gave to you and all the improvements I just made to the building. So if I miss my $4,000 payment, I just lost 80 grand. Now the incentives are in the right place for me because I'm not losing my 80 grand. I'm not losing my down payment. So usually that's a good way to push them across and get them to feel a little bit more comfortable.
Yeah. It's a perfect. They do it sometimes with business lending too, where it's like a default deed they have you sign beforehand, which is for really high risk businesses where lenders do that. Where if it happens, they've already start the process. You already agree to it. So, it's quite the tactic for showing them your trust and showing them kind of what you're working on, and what you've done before. So kind of as we're kind of closing up here a little bit, what kind of advice would you offer to investors that are seeking to follow your footsteps and kind of structure creative financing deals?
Get around people who've, obviously I have my community, we teach this, but I'm not here to promote my community by any means, but we do teach that twice a week. But if the quickest way to get and do this stuff is get surrounded by people who are actually doing it. It's, one of the ones where you're the average of the 5 people you spend your most time with. If you hang out with 5 millionaires, you're going to be the 6th. You hang out with 5 hard drug users, you're probably going to be the 6th. It's relatively the same speaking. So getting around people who are actually doing it is incredibly, incredibly valuable in my opinion, because they're going to help you, and they've already experienced, and they already fell and tripped their knees and scraped their elbows, so they're going to save you a lot of pain, a lot of time, and a lot of money wasted on things that they've already done that didn't work. But that would be my recommendation. Or if you can find someone, this is probably going to be for someone who's more newer in their career, is find someone who's doing what you want to do and go offer to work for free for them. One, I don't think you should ever work for money. You should work for education. But by doing this, so few people are willing to do this, but they're leaving an incredible education on the table by not doing it. Versus, say example, now I'm not looking for anyone to work for free. I already have my team and all of that set up. Say someone comes and works for me for 6, 8, 10, 12 months. what do you think they're going to learn in that time frame? They're going to learn everything I do, and they're going to learn how I do it. And then if they just leave and they just execute on what they learn, they can do it for themselves. So I think people overlook that drastically. Work for education, not for money. And then when you get comfortable enough and you put enough reps in, you're going to get comfortable that you can go and you can leave and you can start doing that on your own. So I think that's really, really an important piece that very few people are willing to do, is that aspect. But that's what I would recommend for someone. Go find someone who's doing what you want and work for free for the education, not the money.
On the other hand, what mistakes do you think you see many investors make when they're trying to structure creative financing deals, maybe kind of on the deal level?
When the deal level, I think that mistakes, I see a lot of mistakes in underwriting. I see a lot of mistakes in construction. People are generally they're budgeting too low, or I see a lot of mistakes in that. I see a lot of mistakes in a lot of hairy areas like assumable loans, non-assumable loans, contracts for deeds. They don't quite understand this fully. And then also, like if you're talking to a seller in the creative space, you have to be an expert in it. You have to be able to talk to this like the back of your hand, because if a confused mind is always no. Whether if that's a seller or if that's you're raising capital. In any scenario, a confused mind is always no. So you want to be able to talk like an expert and, be able to explain it in a third grader level, explain this to a third grader. So that's another big mistake. People, they go in, they try to do this, but they themselves don't really fully understand what they're doing quite yet. And then they just fumble the opportunity. So I see that a lot as well too.
Last thing before we get information on how people can reach out to you, investors, you talked about underwriting, but how do your investors, avoid analysis paralysis? Because I feel it's a big thing when you're starting off in real estate investing, no matter kind of what your niche is.
Analysis paralysis. Yeah, I see that a lot. I mean, ultimately, I look at it, you can have all the education you want, you can do all the things, all the right things, but unless you execute, you're wasting your time. You're wasting your time and you're wasting your money unless you execute. So having executional skills is incredibly important, and not just real estate, any business, because ultimately, if you're just learning and not executing, you're wasting time and money. But to piggyback on that, on how you could get around that, like I mentioned earlier, go work for someone who's already doing it. Now you're putting in the reps, so you're actively doing it, just like you're in the gym, you're putting in the reps. You're actively doing it, but you're not doing it on your dime, so to say. So this is how you can start getting more familiar with the business, but you're also not taking the risk on that operator, that other investor is doing. So here you get the practice. You get the practice for free here, and you get to learn a lot of the mistakes that person has made, and a lot of the pitfalls, and a lot of the costly things that happen to them. So that's what I'd recommend that as well too, because this is how you're going to practice. You're going to practice for free this way, or if they're nice enough, you're going to get paid. You're going to get paid to practice this way.
Awesome. Morgan, well, thank you so much for coming on the show today. How can our listeners a little more about you and your business?
Oh, well, thank you for having me. I'm pretty active on social media. If I can help anyone in any way, shape, or form, you can just reach out to me on like Instagram or something. It's Morgan Ehrenzeller, literally just my name. I have LinkedIn as well. Or you can go to my website, Ehrenzeller Capital, email me, morgan@ehrenzellercapital.com, or Morgan at thecloserstable.com. Yeah, I'm mostly active though, and really active on social media. If anyone has any questions or if I can help them in any way, just shoot me a direct message and we can take it from there.
Morgan, thank you so much for coming on today. We'll put all those links into the show notes, and looking forward to connecting with you here in the near future.
Charles, thanks for having me. It was a pleasure and a fun conversation.
Hi guys, it's Charles from the Global Investors Podcast. I hope you enjoyed the show. If you're interested in getting involved with real estate but you don't know where to begin, set up a free 30-minute strategy call with me at schedulecharles.com. That's schedulecharles.com. Thank you.
Nothing in this episode should be considered specific, personal, or professional advice. Any investment opportunities mentioned on this podcast are limited to accredited investors. Any investments will only be made with proper disclosure, subscription documentation, and are subject to all applicable laws. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice. Opinions of guests are their own. Information is not guaranteed. All investment strategies have the potential for profit or loss. The host is operating on behalf of Syndication Superstars, LLC exclusively.